this session on private debt and direct lending opportunities in 2021. We have an excellent group of speakers today with very diverse backgrounds, very diverse experiences. And we want to encourage everybody that's listening in to get involved in the presentation by asking questions and pushing this esteemed group of speakers to achieve their very best in the discussion today. With that said, my name is Michael Corcelli. I'm the founder and chairman of FLAIA, a 501c6 nonprofit that basically puts together these events and hosts these events. Prior to my work at FLAIA, I ran a global macroeconomic hedge fund. And prior to my hedge fund experience, I started my career at UBS as a private banker. Bill, since we're just going to go in order, do you mind giving an introduction to you, your firm, what it is that you do at PFM?
Sure. So Bill Whale, I'm the Global Alternatives Manager at PFM Asset Management. We're an OCIO and consulting provider to institutional clients, headquartered in Philadelphia. So today I'll hope to give you guys a perspective on private debt from an institutional allocator perspective.
Okay, great. Mark Fitzpatrick, do you mind giving a background on what you do at Glide Capital?
Yeah, happy to. Thanks a lot, Michael. Mark Fitzpatrick, managing partner at Glide Capital, based here in Miami. We started the firm 6 years ago, actually, to take advantage of this private credit opportunity and help family offices and wealth managers. So we'll kind of focus on that group and of allocators. The private credit industry is obviously a very interesting one, but very fragmented. It takes a lot of work to actually go through and find these managers and build portfolios. So we help these family offices and wealth managers do it in a very efficient way. We've spoken to over 600 managers in the space over the 6 years, and we've built over 50 portfolios in our structure, have about 500 million in assets, working with 30 wealth managers internationally.
Thank you very much, Mark. Mark Bell, Balentine.
Yeah, absolutely. Thank you, Michael. So I'm Mark Bell with Balentine. Balentine is a RIA. We manage a small amount of institutional capital, but we're primarily focused on ultra high nets and family offices. I head up our private credit and private equity aspect of the firm and also work with our family offices. So hope to bring the perspective of how we're thinking about building portfolios for our intergenerational clients.
Thank you very much, Mark. Brett Hickey from Star Mountain Capital. Brett, do you mind giving an introduction of yourself and what you do at Star Mountain?
Sure, happy to. I guess I do, first off, whatever my team kind of directs me towards, but we're a lower middle market asset manager focused exclusively on US non-sponsored credit. We manage approximately $2 billion. I've been investing in alternative credit now for over 20 years, everything big and small, including buying and selling alternative credit asset managers. And we formed Star Mountain really focus on two critical trends and themes. One is aging demographics and helping smaller businesses finance acquisitions and grow to sell into the more efficient middle market, which are mainly family and founder-owned businesses. The second is purchasing secondary limited partnership interests in complex lower middle market funds and target generating meaningful alpha with low beta relative to other market segments.
Awesome. Thank you, Brett. So I'm going to start off with Mark Fitzpatrick. Mark, first off, your mic is on mute. If you can unmute yourself. And because you've met with a lot of managers, over the years, and you're very much looking across the broad spectrum in private debt and direct lending. I thought that an overview of performance in 2020 and an outlook as far as like what you're. Let's start with an overview of 2020 performance in the space, and just if you don't mind going into that from just that perspective for now, that would be great.
Yeah, happy to do so. So overall, 2020 performance was as expected for us, which is a good sign. This is one of the first real tests in this fast-growing asset classes. That again, it depends on what lens you're taking as you're evaluating performance. Obviously, if you're comparing to Tesla and Amazon and crypto and GameStop, well, we underperform, but that's not the bucket we're in. We're in a fixed income replacement. And what we saw is consistent performance that again, we've spoken to over 600 managers. They didn't all do well by any means. We focus on groups that have very strong collateral against their loans and know how to take over those collateral and operate it. So as long as you're focusing within that area with good asset managers and are not investing into kind of some of these tourists in the industry that are coming in for the higher yield but may not have the asset management capabilities, it performed well. So it was it was a good year, I think, and a good test for us. There any issues that happened basically, that we saw were more of a liquidity issue. If all of a sudden you've got an open-ended vehicle and investors are running to the gate, and that there's a mismatch of liquidity. In some situations you ran into that, but as far as the overall performance and volatility, then it performed well.
Awesome. Thank you. Thank you very much, Mark. Does anyone want to add on the performance space? What they've been thinking about regarding 2020 and some of the insights that you've gleaned from a very challenging, stressful year?
Yeah, well, Michael, I'll add a couple factual data points that are more systematic as far as data. One of them is a surprise to many people, and this is all publicly available data, but not so easy to find. If anybody wants, please reach out afterwards and I'll be happy to provide it to you. Lower middle market private businesses in the US, on average across the last few years, grew revenue both faster and in a less volatile manner than S&P 500 companies. So as a lender, it's nice to lend to revenue that's more stable and grows faster. It's easier to be right when your revenue is growing. And as far as not losing money as a lender, which is a critical part of generating returns, is preserving capital. The second piece of data that is also third-party, very big database is from Standard & Poor's and Moody's. One of the things S&P found is that the default rates of the larger loans were 3 times higher systematically over the last approximately 25 years compared to smaller loans. For sake of clarity, this doesn't include startups when they say smaller loans, right? These are smaller established businesses, not startups, just to clarify that. What they found is that the default rates for the larger loans to larger companies were 3 times higher. And I think what a lot of investors miscalibrate when we think about risk and reward is they forget about capital inflows, capital efficiency requirements, and supply demand. If you have a lot of people needing to put a lot of money quickly into things, they have to put it into things they can quickly put large volumes of capital, because the inherent assumption is that bigger companies would be safer. And the inherent assumption is that because you're getting a lower return in the larger high yield market, for example, you would hope that you're getting a lower risk profile. We've never seen data to support that. And there's a lot of third-party data to the contrary. And I think it's because people forget about labor and they forget about capital market efficiencies that play a huge role, and perhaps bigger today than ever, given the massive capital inflows into private credit over the last 6, 7, 8 years as yields have been low, which will likely persist at least for the next, I would presume, couple to few years ahead. So those are a few data points that I think are valuable and perhaps relevant for context as we think about the rest of the panel that I thought worth sharing.
Hey, thank you, Brett. Appreciate that. Mark, Bill, this next one's for you from an investor allocator perspective. Mark Bell and Bill. So can you tell me why you're spending time on private credit right now, today?
Bill, you want to go first?
Sure, happy to do it. So you've really seen a drop in yields in your traditional fixed bucket. So when you're looking at building a portfolio, for us, for institutional clients with a long-term time horizon, we're seeing now more than ever it makes sense to incorporate yield enhancing, alternative credit strategies, direct lending, private debt, more niche private capital strategies that overall have a higher net IRR expectation. You will see, that often this can increase your risk depending on how you measure your risk. We like to think that there's two types of risk. There's the risk in the form of standard deviation, and then there's the risk in the form of, meeting your long-term return target or not meeting that long-term return target. So incorporating private capital and these, especially these more niche strategies that, could result in losses potentially. This may increase your expectation for, standard deviation in the short term, but when you're dealing with a longer term time horizon client who's, finding it more difficult to meet their 7% return target over, 50 years with just a standard 60-40, we advocate for, incorporating, direct lending, maybe complementing it with venture debt and or other strategies that we might find interesting, either tactically or strategically, as a way to mitigate that second form of risk I mentioned.
Awesome, thank you, Bill. Mark, do you want to add on?
Yeah, I would say a little, we kind of come at it a little bit different from Bill in that we're mainly working with families, and it's ironic that, very wealthy families also have high spending demands on their portfolios, which obviously traditional fixed income isn't able to provide. And so looking at different types of yield, whether it's certain types of cash flowing real estate, or in particular for us, private credit has become really important as families look for their portfolios to do work in order to meet their spending needs. And so we've been spending more and more time as we are spending less and less time investing in traditional fixed income assets. And I think Brett makes a really interesting point about the perception versus the realities of the risks there. I think we were hopeful a little bit at the beginning of 2020 that there might be some distressed opportunities. Our families usually like to buy assets at lower than fair market value. We saw almost none of that. I think the panel can maybe weigh in. I think PPP was maybe a big part of that, but we've been impressed with the resiliency of the asset. And I think our clients are going to continue to feel comfortable allocating a bigger portion of their portfolio as they look to earn and spend the income that's coming off of their private credit allocation.
Thank you, Mark. Passing over to Mark Fitzpatrick. Mark Fitzpatrick, where do you see good opportunities within private credit in 2021? What are some of the key risks and considerations that are conscious in your mind today as you look at the space as an interesting investment opportunity?
Yeah, thanks, Michael. Obviously, we've looked at a lot of managers up until this point. It's over 600, and I think Preqin estimates somewhere around 2,000 managers in the private credit industry. So it's important to kind of compartmentalize the different strategies out there and understand the lens that we're coming from. So first and foremost, there's a lot of capital more in the middle market kind of lending space, and that's a good home for the institutions. And what we're focused on is more shorter term kind of strategies, though. We don't get into the 7 to 10 year type funds. We focus more on the 2-3 year type liquidity. So that's important to understand the lens that we're working under right now. Up until this point, again, we're always focused on finding those managers that have a capital preservation strategy first and foremost. We're thinking on behalf of clients that have maybe saved all their earnings and or sold a company and need some cash flow on an ongoing basis to pay their retirement. And we know that, for example, if you need $200,000 a year, if you're making 2%, then you need $10 million. But if you're making 8%, you only need $2.5 million. So the difference in yield has a big impact there. We focus on well collateralized strategies, and we're always going to do that. And we think that that's where the opportunities are, but they're emerging in many different segments. We've always been a big commercial real estate lender, bridge lending strategies where somebody comes in and a developer puts in 30-40% of a deal and wants to borrow the other 60 or 70%, and there's a first lien on the property. We think that that should continue to provide good yield in, say, the 7, 8, 9% range. And you can be very diversified over multiple deals there. We're doing a lot in the life settlement space. Business lending is interesting. There's different segments within. Venture debt is an interesting strategy that's growing. We're looking at cannabis. We're looking to take advantage of aircraft leasing. 2020 was one of those strategies that was hit harder, although they still preserved capital, at least the groups that we're invested into. Now the opportunity seems even better. And I guess lastly, we're looking at those groups that are going to be opportunistic. I mentioned earlier on that there were a lot of kind of tourists in the private debt industry as they're attracted to the higher yield, and that there's lots and lots of funds that are being created. Well, we're always warned by many of our managers, and we're seeing it, the difference between the quality of the funds and their preparedness to underwrite, to taking over assets and operating them. Some of those groups are trying to get out of the industry now, and you know, some banks are going to be trying to unload loans. So we'll be looking at non-performing loans and opportunistic funds looking to take advantage of getting debt at a much cheaper rate and being able to operate those assets and getting a higher yield.
So, Mark, thank you so much for that. Brett, we're going to get to you in 1 second. I want to come back to Bill and Mark Bell, and I want to just ask them within, you know, direct lending and, you know, private debt, private credit, what are the top 3 areas, because it's a very diverse, you know, space. What are the top 3 areas that you're like thinking about today and considering?
You want to go first, Mark?
Sure.
So recently, you know, in 2020, we were looking at distress, special situations, something to capitalize on the dislocations in the market created by COVID. We think that there's still some opportunity there, but it's a window that's you know, closing relatively quickly. But there's certainly remaining dislocations in the market in the sectors most impacted by the social distancing. Additionally, we continue to really appreciate venture debt as a niche alpha generating sub-strategy of private debt. And I think there's some interesting, while life settlements isn't quite, right for our pensions, given the shared risk between the pension and life settlements, on extension of life. But we think there's interesting things going on in litigation finance. It's a bit more niche, but burgeoning and really strong, alpha return potential in that space for someone who's able to accept that form of risk.
Yeah, and I would say, Michael, from our end, ours are probably a little less exotic. I would say number one, we're allocating to what we would call lower middle market, first lien cash flow lending. That's kind of a 3 to 5 times EBITDA. A lot of times behind, sponsor private equity transaction. Number two, we've had good success with that. Number one. Number two, looking for a little bit more of a unitranche, traditional mezz type lender, where we're looking to break into kind of low double-digit type yields for our clients. And then the third area we've spent a lot of time and have a lot of interest is in what we call fix and flip, but essentially less than 1 year duration on repositioning single-family real estate assets.
Awesome. Thank you very much. So Brett, Hickey, we're going to come to you now as somebody who's on the front lines doing the underwriting and, getting inside of these businesses and these different opportunities. Can you make the case for me, what yields and, what you're seeing and how you're mitigating risk within, your fund, within your company?
Yeah, sure, Michael. I guess maybe to frame it, we're all looking for alpha at the end of the day. Capital protection, systematic returns, low volatility is a component of alpha generation. And many investors today are also, as Mark mentioned, looking for capital protection. And as Mark mentioned, looking for that consistent yield. And then as Bill mentioned, looking for alpha, looking to generate a better return on their capital, not just find the quick and easy stuff, which is, of course, a key part of what what Mark and Bill's jobs are focused on. So when we think about where do you systematically find opportunity that's not luck oriented but that's repeatable, you have to think about what things are going to drive that. So I would say market inefficiencies. So if it's a private equity owned business looking for a borrower and has Goldman Sachs out to try to find the best lender, that's going to be an extraordinarily competitive process. And anybody who says, well, I have an edge or better relationship, that matters around the edges, but edges measured in basis points, right? Not measured in percentage points. Therefore, when you think about inefficiencies, you really have to find complexity. So either industry segments, as Bill mentioned, like venture debt is an example of that. But you've got to find things that have some complexity associated with them. Inefficiency of labor, where it's labor intensive, which is a barrier to entry for the big asset managers, the big insurance companies, and people that need to deploy a lot of capital. So where we find a lot of inefficiencies are with founder and family-owned businesses that don't bring deals packaged with a bow. You have to be able to find them in the first place. So Star Mountain, for example, we have at least one person locally in over 20 cities across the country that helps us originate approximately 2,000 direct loans a year, of which we invest in about 30 of those businesses. So you've got to find these businesses. You need the expertise to underwrite and add value to them, both of which require specialization and labor intensity. And when you think of the word alpha, it's how do you get paid for something that's not risk? So labor is a good thing to get paid for. Another good thing to get paid for to generate alpha is value add. So for example, our team have ran a number of the largest global investment banks on Wall Street. My partner Brian was the global head of M&A. Other partners were global heads of Goldman Sachs, UBS, and so forth. And so we're really good at helping strategically advise businesses. We're not going to tell them how to run their business better. We need to find good, high quality operating businesses. But when you take a retiring demographic and you overlay that with the fact that 95% of the 200,000 private businesses in the US lower middle market are still family and founder owned, not yet owned by private equity firms, which will be a transition over the next decade. If you can take two smaller businesses that each do 10 million of EBITDA and make one 20 million EBITDA business, that $20 million EBITDA business on average can generally command a 25 or even higher % enterprise value multiple. So it's a really easy way to increase value for shareholders. And when you think about an aging demographic, right, we have a third of the population in the US, many of whom own these private businesses that say, I'm an empty nester now, still have energy, got a lot of knowledge. And that's the apex of when you want to back people, when they have experience and energy. So backing the baby boomers, being a bit generalizing, of course, to finance acquisitions is very labor intensive and complex, but is something that one can generate a lot of alpha in, especially if you can add value to these businesses and get warrants and other equity upside, which creates the potential for tax benefits for people that can benefit from long-term capital gains and so forth, as well as just additional right tail skew to upside, so that when your loans go well, you can make some real upside, which both is good for creating returns and also protecting capital, because in most fixed income portfolios, if pricing changes, like if you're in high yield right now and rates go up a little bit, you can lose money, not because of losses, right? Unless you're fully held to maturity in all assets, then you better understand the structure you're in, better understand the structure that the manager you've given money to is in, and so forth. So a lot of sophisticated investors today are really concerned with the risks with high yield, because the rates are not that high, and a small price adjustment can basically have you be almost underwater. And so we find that lower middle market, what people call non-sponsor, meaning not owned by a private equity firm, lending, where we add an additional angle at Star Mountain, where you're really looking to add value, help them find an acquisition, analyze it, negotiate it, structure it, integrate it, then package their business up with a bow to sell it to the middle market private equity firms. And as many of you would know, the amount of capital and the valuations in the middle market are higher than ever. So the valuation arbitrage between the lower middle market and the middle market is higher than it's ever been. It all kind of flows down from the public markets at the end of the day, right? So capitalizing on the retiring demographic, the labor complexity, the valuation arbitrage is something that we believe at Star Mountain that we can continue to most systematically do, where we're not relying on thinking that we're smarter than somebody else in a commodity driven risk or something of that nature. The second thing that we find systematically interesting that we've been also doing now for a couple decades is buying secondary LP interests in some of these small niche strategies where you can find assets that are hard to understand, hard to find. You target buying them at a discount, and as loans are more matured, the probability of default historically decreases as well. So that can be another beneficial way to search for alpha in a way that you can still have strong covenants, keep leverage ratios low, have systematic underwriting, not, hey, quickly get this deal done. I think there are a lot of risks right now that people are missing in the market, including Ebitda adjustments and how quick the diligence process has to be, and then alignment of interest. For everybody on this panel, they've all been worked through cycles. It's one thing to put money out. To get it back, you need people focused to work through the problems. And I think understanding the managers, I know Fitzpatrick spoke about that, but having a highly aligned team of people with their own capital at risk, people not motivated to put a loan on the books, like we've all read about, 08 market downturn, a lot of real estate, hey, just fill this document out this way, we'll get it on the books. Well, because they get paid. I would caution people to look at how many private credit managers pay their originators for putting a loan on the books that have zero carried interest to share in the profits, zero personal capital at risk in the loan to care about protecting the capital. And I was just thinking like, hey, maybe things are right, but if you keep interest aligned, we believe the probability of things working out well is more repeatable.
All right. So thank you, Brett. So Bill, I heard you bring up venture debt a a couple of times. Do you mind elaborating more why this is interesting? What a good, venture debt fund looks like, what you're expecting from a return, like risk perspective?
Yeah, great question. So venture debt is, typically short duration loan to an early stage company, often sponsored by a private equity sponsor. And typically you're looking at a low to mid teens expected IRR. And these loans will often incorporate warrants, to a varying degree, depending on where the debt manager is, positioning themselves in the market. So, we expect from our funds that we work with a net IRR in the tune of 10 to 15%. We think it's really interesting. It's a burgeoning sub strategy of private debt, and we think it's important that someone who's not familiar with venture debt focus more on the word debt than the word venture, because when you look at the return distribution of a typical private or a venture debt fund, you're expecting low losses, a low loss rate from a good manager, with each of the loans expected to generate a moderate return. That averages out to that 10 low to mid teens IRR that gets you, on a fund level, that 10 to 15% net IRR, as opposed to a venture fund where you're expecting, many of these, deals to result in no value and a few or one of your deals to return the portfolio. So that's, an important thing to consider. And we think, this is a really good complement to a diversified private debt portfolio. For us, we typically, begin with something in this middle to lower middle market direct lending space as what we call the core of our private debt portfolio. And then we accompany that with smaller allocations to what we call these satellite private debt funds. And one of our best ideas continues to be, these good venture debt funds that are, we see continuing to generate alpha by issuing loans in this less efficient, part of the market.
Thank you, Bill. Mark Bell, when you're working with families, what are they expecting from direct lending, private debt, private credit strategies? What's the target return? What's the liquidity profile? Walk us through what the expectations are.
Yeah. So Michael, the challenge that a lot of our families have is really the tax treatment around a lot of our private credit sleeves. Most of our clients, or the preponderance of our clients, are in pretty high tax brackets and would like as much of their income as possible to come to them in the form of long-term capital gains. But like I said at the beginning of our discussion, many of our families, if not most, have sold a meaningful business and are now looking for their portfolio to support their spending. We generally, as we construct private debt portfolios, are thinking about yields that are inside our forecast for long-term equities. So we think of equities as kind of a 7 to 9% long-term. We look for private debt to be in that kind of 4 to 7, depending, really around 5.5 to 6. And so to Mark Fitzpatrick's discussion, a lot of the risks we're taking and the portfolios we're assembling is based on really the sustainable spend of families and how much of it we think we can take in the private debt area. We are concerned, or concerned's not the right word, but we are cautious that as people shift away from traditional fixed income instruments, historically we're in Georgia, which is a state that has income tax. A lot of our clients would hold a lot of municipal debt. Today, maybe clients would hold 5 to 10% municipal debt. Today, that's closer to 1 or 2%. We think selling a municipal bond and doing a 4.5 times EBITDA last dollar loan is a very different risk. And so we want to make sure our clients understand that. But we look for kind of what we would say high single digits as we try to put things together.
Okay, thank you. Brett, Hickey, these guys have, a ton of experience. They're on the allocator side of the table. They're thinking about allocating, money, to the space. With regards to your returns, your funds, the deals that you structure, are there any particular components of what you do at Star Mountain to get their returns up a little higher than you normally would with just straight like loans to these businesses outside of the niches that you're working in, based on like warrants or anything inside of that nature?
It's a good question. So I think the first thing I've always found in asset management in general is starting in the right market segment. So for example, there's some market segments that no matter how talented the team is, they're just very difficult. Restaurants, retail, and so forth. So I think what you want to start with is the right business plan. And then step two is have a specialized team aligned the right way to execute against that business plan. So at Star Mountain, with approximately 45 full-time people, 30 additional operating partners, we have 75 people that do nothing but aggressively focus on the US lower middle market, with 100% of them sharing in the profits, 100% employee owned, and every single person that's even mid-level and above having meaningful personal capital invested at risk and focused on all of our loans and all of our investing activity. And that all may sound like, yeah, that makes sense, and that's relatively straightforward. That isn't how most asset managers are structured. So we're very specialized and very focused on what we do, and that's allowed us to build a differentiated business with a specialized data entry team in India, where we have over 8 full-time people now. I opened that office 11 years ago, having a lot of custom-built technology to address the massive volume of data that we have. Right? When you look at thousands of private deals a year and you're only going to do 30, you've got to be able to sift through the information, right? That all sounds great. Oh, fantastic. You're selective. Well, how do you work that through the funnel, not disenfranchise relationships that refer you deals, the little accounting firms and stuff like that? And I think it's having the discipline and experience within your team to know what you're doing. And then I think the workout capabilities where at Star Mountain, for example, many of my partners have ran very large private equity firms. My partner Chris ran a $6 billion controlled buyout business, for example. So we have a lot of controlled buyout experience. We also have a lot of C-level operating experience where many of my partners have been full-time presidents, CFOs, COOs, CTOs of lower middle market companies. So when we're speaking with these business owners, that resonates. We've been in their seat. We know how to work through both challenges and opportunities. And as a strategic lender, where we get equity upside, as Mark said, but we pay taxes as well. And so we're always looking for as much long-term capital gains upside as possible, not just as much upside as possible, and multiple of capital, not just IRR. We want to get paid a good multiple of capital for our money being put at risk. We think that's also an important variable in addition to the IRR. And so to do that, you want to be able to add a lot of value to the companies, and you want to also be able to protect the value. And those experiences and that alignment helps you add value. And also, if you have challenges which occur, you have the ability to work through those challenges with the right type of covenants and capabilities to work through problems. I think that's critical in capital protection and alpha optimization. And I can't talk about a return specifically, but that is what has allowed us to generate quite substantial alpha that we target continue generating into the future. And then I think one of the things that in this type of market environment, which I presume we'd all view as different than anything we've ever experienced before, it's almost a bit of 08 with a bit of 01, blended together with a few other black swans flying around, playing with unicorns up in the air. And when it rains, I'm not sure what the birds will all look like and what's underneath all the paint that's flying around there. But I would presume there are a lot of challenges ahead as the economy retires, as underfunded pension plans finally have to start paying out more of their aging pension years. Like, to think there aren't substantial challenges ahead, I think is a fool's errand. Query when they will happen and how much of an impact. But therefore, one of the things that we can do about an uncertain world, I wish I had a better crystal ball to help with, but you can build a more diversified and defensive portfolio with businesses that make sense, with valuations that make sense, with leverage levels that allow for both macroeconomic and idiosyncratic risks to play through. And I think that's the basic stuff that we're built to execute against.
Thank you, Brett. Mark Fitzpatrick, so you brought up, when I asked you about, the opportunities in the space, you actually brought up real estate, right? And real estate development. This particular panel, the event is, an intersection between businesses and real estate. But this particular panel was supposed to be everything outside of real estate. But the fact that you brought it up, I would love to hear, why you're thinking about, direct lending and private debt in the real estate space, and ask, the other Mark and Bill to opine on your, your explanation.
Sure. So I guess, sorry for not reading the notes of this. Wasn't supposed to address real estate, but it's a big part of what we've done. Obviously, that the private credit industry is humongous and growing fast. And there's a lot of things that we're looking for these days. But one thing that is really important for us is collateral. That there's a lot of strategies in private credit that might be lending against receivables or future cash flows. And if there's any issues, it can go to zero. And what we're looking for is worst case scenario. This is a capital preservation strategy first. It's for looking for assets that we can go out there and verify. So one of the things that we do with our managers is we have asked them for a list of all the loans that they have. And we check to make sure that they have a UCC filing on those properties and a first lien on these properties. But more importantly, that we want to grill them on what they're going to do if the developer hands over the keys and says you have to operate this asset. Again, we know there's a huge buffer because the developer is the one with the equity. They're the ones with the most capital at risk. They can lose 100% of their 30-40% down, and that they would only take over the keys if they're in a position where the property has gone down precipitously. And we're really not seeing very many defaults because properties are not going down that much. And to Brett's point, we want to focus on groups that really understand the underlying assets and know how to operate them, that we're staying away from groups that might be focused on high, say, restaurants and hotels and high operating businesses, and focusing more on multifamily type projects and deep analysis of where is the growth and where are the needs in our economy today, and in what locations too. We're seeing a lot of growth in the South. So we sleep well at night in strategies where we know that there's very strong collateral, there's very strong operators at the end of the day that can take over the property. And if they are given the property, well, they just got it at 30-40% discount of where they loaned at. And in most of these cases, they're actually making a lot more than if they were to pay them the interest. So again, capital preservation first. And if they were to default and take it over, then that affects the liquidity, but we're so well diversified and the defaults are low that we can always count on this liquidity. And there's a lot of transactions in that space and professionals that need this access to quick capital that the banks can't provide.
Awesome. Mark Bell?
Yeah, no, I mean, I would just say our families are always very comfortable with real estate, and they get real estate lending. The biggest thing with all of private credit is we want to make sure that we're truly taking credit risk and not taking what we call capped equity risk. But private real estate lending is a big part of what we do, both opportunistically and systematically.
Awesome. Bill?
Yeah, we meet with asset-backed managers, asset-backed lending managers, and in certain solutions, we might utilize it perhaps with a client with a lower risk return mandate, a special solution. As a whole, just structurally, it doesn't typically make sense in the exposure to private debt we're trying to provide here. Typically, we're looking to outperform the Cliffwater Direct Lending Index, so it just means that our risk return target is too high to make asset-backed real estate backed loans work for us. These strategies, typically have you'd be wise to expect like 6 to 7% over the long term, and that just doesn't fly with outperforming Cliffwater over the long term. So generally not a huge focus of ours, but it certainly makes sense when you're talking about someone or a portfolio that's seeking to just generate a safe, enhanced alternative credit like returns that over the market cycle will outperform your traditional fixed.
Okay. I'd like to go across the board here and just like, if this was 2008, what did you think would be better performing over the next 10 years? Business, direct lending, or real estate? And then, but instead of asking about 08, if we ask today and we project 10 years into the future, where's your bet? Risk adjusted for risk.
So go ahead, Bill. Sorry.
No, you go ahead, please.
Okay, on our side, what we're also looking for is growth and new industries. That the world is changing faster and faster than ever before. We all know that industries are being created in months, especially going through 2020, and how the whole world has to readjust. There are certain businesses that have a lot of cash flow that are coming in that need solutions, and they need to be able to grow to handle that. And in the past, there were equity partners are the only way that they could really raise capital, because banks, they're just not sophisticated enough to get involved into these transactions. Sorry, banks, but we see that there is a lot of good return available for those that can evaluate these fast-growing companies, that can really be a partner to them, that can help them in their growth process without being dilutive. Those groups will pay high interest rates because it is less expensive than issuing equity, and especially for the right partners. So I would say that that segment within business lending, and to try and find these new industries, whether it's cannabis or other spaces, have good potential as long as you're with institutional managers in those spaces, more so than real estate. But real estate's a very kind of safe, and there's other asset-backed strategies that I also think would be strong.
Awesome. Mark Bell, Bill.
Yeah, sure. No, I would just say, where we sit, we are really in the stay rich business. And so capital preservation, we like lending strategies. And from a risk adjusted perspective, we're going to continue to like things like the whole private capital spectrum. Obviously, like Mark said, as we think about areas for growth, we do think what we call global transition, from a carbon-based economy is a $100 trillion opportunity globally. And so we are in discussions with, call it infrastructure lending, or kind of people who are looking to reposition assets. That would be an area that we haven't yet gotten into, but we think we would see as good returns in 2021. The other area that we'd like, really because we continue to see some distress and we think we're buying value, is we continue to like existing hospitality assets. We think, travel, we already see kind of a full summer travel rebound, and maybe business travel is behind that, although all of us can meet and have this conversation via Zoom, so it might look different. But transition from carbon-based economy and hospitality would be the two areas that we're excited about prospectively in the coming year.
Thank you, Bill.
Yeah, I think those were two great answers. I think I side with them that, where I put my money going forward, if you're looking for a higher risk adjusted return, would still be in the direct lending space, corporate direct lending over asset backed. There's a spectrum on both sides, and risk adjusted, that's the interesting part of the question. You could find safer, riskier strategies within each, but as Mark Fitzpatrick said, these companies are looking at their financing, and the debt is cheaper than the equity. And with the corporate direct lending, you don't have the backstop of a real asset that lowers your risk, but you do have a higher compensation typically to the direct lender. And then, to Brett Hickey's point, particularly if you find yourself going lower market, non-sponsored, skilled manager, that's where you could really generate some alpha relative to all those strategies that were mentioned.
Awesome.
Yeah, Michael, what I would add to that is thinking of the future. I would look to the past, and then I would calibrate that to the future. As Fitzpatrick talked about, industries are changing rapidly, and something that was a great business 20 years ago may not be in the future, and vice versa. So I think that's really important to really understand global trends and understand what's going on, when and where. Because if you get the macro trends wrong, it's really hard to make the rest work. If you look at Moody's, as we switch gears to the past, so what can we learn from it? Moody's did a 25-year report, which spans lots of types of economic environments. And systematically, they found the single largest determinant of defaults was how much leverage you had in your business. The number 2 and number 3 items, which start to account for around 60% of your probability of defaulting across an extremely long period of time and a lot of transactions and industries and so forth, was liquidity. So if you keep your leverage low enough and you keep liquidity high enough and you have a good cash flowing business with a diverse customer base, we always like to remember people that it's cash, remind people that cash pays employees, taxes, services, interest, and debt, and allows you to work through things. And certain assets do have an ordinary liquidation value, but in market downturns, it's just like hoping that some liquid assets will have liquidity. I think that's one of the easiest things to get paid for in life, is a little bit less liquidity, because often the things you think will have liquidity either don't really, or not at a price that you're interested in if there are challenges, versus you just having your own idiosyncratic desire for liquidity. And so I would say that high levered loans in general, I think systematically will probably do worse, especially if you look at Lincoln, the largest third party quarterly valuation firm in the country. If you look at their recent study, they show you that average Ebitda adjustments are around 35%. When you think of that as the average, that means that some are 50, some are 10. You think about it, an adjusted EBITDA that somebody says, well, this is 6 times, and it's actually 9 in reality. And then you have COVID adjustments, right, into an uncertain world. I would have to guess that you have a lot of businesses that won't be able to service higher interest rates if they come, won't be able to get debt refinanced when it comes due. and that there is the potential for a lot of challenges in all sectors, just with higher levered loans in general, which is more systematically the larger markets. And that's, similar to what S&P found historically as well. But I think that gap, that's historically a 3 times difference in defaults, I actually think that gap is likely to be larger if we do come to a market downturn over the next few years, which I would guess that we will to some capacity at least.
Awesome. So look, I want to go through and ask each of you if you have any questions that came up for one of your fellow panelists, and just bring up those questions that you have of each other. I know it's a little unorthodox, but who has a question for one of the other panelists that they would like to ask?
Well, maybe I'll ask Brett, where you talked a lot about the macro environment and understanding what the change, the winds of change that are happening. What industries are you attracted to? Which ones are you kind of staying away from?
Yeah, it's a great question. I think there's 2 barbells of opportunities that we pretty systematically see. One is basic, boring, low scalable service businesses. So urgent care chains, commercial landscaping, preschool chains, right? Things that they're never going to scale quickly. They're not technology driven businesses, but that generally should be good businesses. I think systematically consolidation and doing roll-ups, which always sound easy, but if you can do it the right way, can be valuable, but I think are harder than some people estimate. But I think that opportunity set is pretty systematic within those defensive, low growth, slow growth industries that are hard to be disrupted by China, hard to be disrupted by technology. People still want them and still view them as a pretty high value spend in their corporate or individual budgets. So that's A. B, then I flip over to businesses that are newer businesses, scalable. We, for example, not long ago, provided capital to a business that's one of the largest advertising platforms on the YouTube channel. So if you think about YouTube, it's owned by Google. YouTube has a tremendous amount of content, user-generated content. So for advertisers, it's a great place to find value in advertising, because you might have some new yoga instructor that has this massive following of the right type of client base. But you want to make sure it's safely done, because maybe that yoga instructor all of a sudden goes on some political rant or any other thing that you don't want your brand associated with from a brand safety perspective. So you have different artificial intelligence, different, machine learning and stuff embedded within, deep kind of trust to create that ecosystem that business is only, called 11 years old or so, didn't really exist 15 years ago, but is growing extremely quickly with a very defensive business. And the market trends and growth, if you look at industry reports and you say, what industries over the next 5 years are anticipated to have a compounded growth rate of, let's say, 12.5% or higher, we always think systematically that it's nice when you're lending to businesses and investing in companies that don't have to steal market share from competitors to be successful. It's nice that they can just kind of grow with the rising tides a little bit. So that's an example within technology, with a telehealth portfolio company that's probably relatively obvious to the long-term trends, accelerated dramatically because of COVID. So good to be lucky sometimes on that perspective as an investor. But those are examples of fast growth trends, which tend to be very technologically driven. So as we continue to grow our team, a lot of our team is very, very deep in technology, not just historical credit underwriters, because a lot of this new tech, it's newer. It's more private equity style people that think about the future that way more so than are just really good at blocking and tackling, which is also important. In the middle, I guess the things that I think are a bit of a challenged land, assets that have limited lives are expensive to hold. So who wants to take over some assets that you have to pay to hold we all probably remember not long ago, I'm not saying that this should have been right, but there was a point in time where it cost you money not long ago to hold a barrel of oil, right? And if you just think about dynamics like that, I think there are more challenges, not specific to oil and gas, but with different types of assets that may not have great useful lives, may be expensive to get recalibrated, have a holding cost associated with them, both sort of physically and financially. So I think those will be some of the types of things that we would stay away from. And then personally, we're not into the speculative areas, so I'm not here to opine on the Bitcoin cryptocurrency type of worlds, but generally, if you look back to '01 and you look at things like this, gold rush, right? Perhaps some people made money, most didn't. And I would guess that'll be an outcome. So if people's risk appetite is there for that type of higher beta trade, then that's a different risk appetite, I guess, than what we think of as desirable as a lender.
All right. Thank you. Thank you, Brett. Who else has a question for one of the other panelists?
Yeah, Mark Fitzpatrick, to what degree are you incorporating non-sponsored funds and investments relative to sponsored?
So I'll be short because I think we're done at 1 o'clock, right, Michael?
I'm actually the next presenter, so.
Oh, perfect. All right.
I'm letting this panel. It's cutting into my time, but it's all good.
Yeah. So we have a few managers. Actually, most of them are based up in Canada, and one of the things that we're trying to do is avoid the masses and going into the same funds that everybody else is going into. We tend to focus on non-sponsored, and we tend to look for kind of shorter term business lending loans to fast growing companies with a lot of cash flow, or at least invest into funds that are identifying those groups. And so it's a little bit earlier stage without private equity kind of investors coming into them.
Mark Bell?
I think that my questions have been answered. I'd be interested, I think, Mark, and understand a little bit of your structure and how you guys, who your typical client looks like, if time permits.
Yeah, it does.
That's happy to take it offline too, but our typical client is an RIA. It's a family office. It's smaller institutions. It's groups that understand that they want to be in private credit, that the story makes a lot of sense, but also understand that the amount of work is infinite to go out there and just speak. We could speak 24/7 to all these managers, and we have to take an institutional approach to doing due diligence and making sure that we have a deep understanding of each one of these managers. So the way that we do it is, again, we've spoken over 600. There's a lot that we could throw out for various reasons. We want to find the best within the short-term well-collateralized private credit strategies. And then each wealth manager can come in and build their own portfolio, whether it's a family office or it's an RIA, and they might say, look, I don't like life settlements, and so I don't want life settlements in the portfolio. So please build me a portfolio of 8 or 10 managers using these groups. Or there could be a shorter term portfolio versus a longer term. So we've got a structure that allows us to build customized portfolios. Obviously, they've got minimums, but it's a lot lower minimum than what you would do if you have to set up the structure yourself. And we all know how much work it is to go out there and do the due diligence. These are private offerings at the end of the day. There's not as much transparency. You got to go out and get it yourself and do your own operational due diligence. And that costs a lot of money. It costs a lot of time. So we're looking for those groups that want to partner with somebody that's already been doing it for the last 6 years.
Thank you. Helpful.
I would, by the way, add a call out just for Mark, knowing the complexity of the credit industry. It's you really have to peel back the onion, know what you're looking at, and have a wide scope and range to pick and hunt for alpha versus just taking a quick cursory look at things. Covenants, the complexity of good credit, there's a lot more weeds and aspects and variabilities than a lot of other asset classes.
Yeah, and once you start peeling the onion, it just doesn't stop.
So guys, I have one question, final question for each of you. I was hoping that we could wrap it up in the next 5 minutes, but you guys did a fantastic job today. It is a very complex topic, and it's a very important part of not only Main Street, but it's an important part of the alternative investment industry as a whole. So excellent job. Thank you so much for being on today. But before we go, I wanted to ask each of you, why you chose to do, what you're doing today. Like what brought you to choose, what you do for a livelihood.
I'll go first if you don't mind, and I actually have to jump. I apologize.
No worries. Go for it, Brett.
I guess first is we like helping and adding value to smaller private businesses. It's a satisfying feeling to add value and help and have people care about what you have to say. And so a lot of these family and founder-owned businesses, they really value what we can bring to the table to help. Their great operating expertise that they bring to the table in the kind of partnership. So that's one. Two is culture is really important to us internally, where everybody's aligned and working together and focused on solving problems as a team. And that's really why I started, this business from a founder hat perspective. And then lastly, as far as the asset class of our business, I like to sleep well at night. I grew up in a very small town in northern Canada, and I can't predict the future any better than other people. So I like to have a diverse portfolio of, senior secured, low leverage loans, but still want to make some money with our time. And that's why we like the warrants, and we like that asymmetrical, hopeful return that we can generate, off of the capital while protecting it. And that kind of serves to protect capital, generate income to live off of, and then hopefully create some additional upside to continue to compound wealth as far as the loans with warrants are concerned.
All right, Brett, thank you very much. I understand you got a job.
Thanks, everybody.
Fitzpatrick.
Yeah, so I like change. I like work. I don't know why. I end up picking up roles that have nonstop work all the time, and I like being different and not trying to follow everybody else. I think that you got to go out there and look at the macro environment and understand where something's been built and where there's big opportunities and inefficiencies, and capitalize on those type of things. That certainly not the smartest guy out there, but like to work hard and like to build. And so that's what we've been doing here, that we saw this emerging opportunity in private credit. The story made sense that, again, the banks, when I think of being a kid, I never went for a bank loan when I was a kid, but I think of going in there and filling out paperwork to your banker. And they look at things like FICO scores and create all these different matrix to see whether or not you qualify for a loan, where they're just scared to own the asset at the end of the day. And so they look at cash flows and other things. Whereas a lot of this, especially after 2008, 2009, there's a big void because the banks weren't lending in so many different areas. And more technology has been allowing us to gather information, and the banks are not the holders of this information. It's out there for everybody to get. So you see groups leaving and specializing in a certain type of lending where they can do things that you can't do in the banks. And so at the same time, we were seeing just a demand for yield that, again, there's different groups out there. If you're looking to get rich, you're in the crypto space, you're in the GameStop space, you're in those spaces. If you're looking to stay rich and just get some yield, well, there's no yield out there now. And so this is an area where there's very, very fertile ground to have a nice consistent yield. But you have to do a ton of work, and we have to do a ton of work and due diligence and speaking with these managers, understanding them. And I just am somehow attracted to strategies that have an infinite amount that you can learn.
Awesome. Thank you, Mark Fitzpatrick. Mark Bell?
Yeah, I guess similar to Mark, I'm interested in complexity and helping people. And so we're privileged to get to do both those things.
Awesome. Thank you. Bill?
Yeah, I'll mirror their comments. I got a finance background, got educated, got a few certifications, fell into this role, and have been able to grow with alternatives within client portfolios here at PFM, and really, be in a place where I can make an impact on portfolio allocation and decision making, which I really enjoy. And I was drawn to finance and being in more of this role where those who are skilled can outperform their peers, and you really can, especially in alts. And to mirror Mark and Mark's comments, it's because to do it right is hard, and it takes a lot of time, a lot of effort, a lot of due diligence, never ending due diligence. But if you take the time and care, you can generate, I think, outperformance relative to peers, and do so. A good manager can do it pretty consistently, and I enjoy doing that for our clients and building well-diversified and differentiated alternatives portfolios.